This morning I've been asked to talk about a commentary by Patrick Harker, who is the president of the Philadelphia Fed, on the shape of the US yield curve as an indicator for the US economy. I saw an interview with Harker yesterday in which he talked about keeping a very close eye on the shape of the US yield curve as the Fed tightens. What is the shape of the US yield curve is a good question to start. So what we measure it as is the difference between US 90-day Treasury bills and US 10-year bonds. And if we look back at the data for the last 40 years, it is indeed an extremely reliable indicator of US recessions. When the US yield curve falls below zero, that is to say, the US 10-year bond yield is below the 90-day Treasury yield, then on the last 4 occasions that has happened, a US recession has followed. It followed in the early 80s when that happened. It followed in the early 90s when that happened. It followed in the very early years of this century when that happened, and it followed in 2008 when that happened. Now, on average, when we look at the relationship between the shape of the yield curve and US GDP, we find the lag is about 5 quarters, but it moves around a lot, and what I've chosen to do is look more closely purely at the data of this century. And so what we're looking at here is the data referring to the first slowdown in the US economy in the beginning of this century, and more importantly, the GFC. What's really interesting about this is that what we see about the relationship between the shape of the yield curve and US GDP is that, is, just to speak as an economist for a moment, curvilinear. What that means is that the yield curve can vary in an enormous range from 4% down to about 0.5%, and it has absolutely no effect upon US GDP after any kind of lag. But once it falls below 0.5%, that is to say, when the US 10-year bond yield is no more than 0.5% higher than Treasury bills, then the US economy does turn to fall into recession, and on the data of this century, that happens 9 quarters later. Now, what's actually happening here? To follow the theory of this, after the manner that's described by Bill Dudley, who's the soon-to-retire president of the New York Fed, what we're actually seeing in the long end of the yield curve is we're seeing the real demand for capital. As investment is stronger, the real demand for capital is stronger. Now, what happens when rates rise at the short end, the short rate of the Treasury bill is what's called a riskless rate. So if you lift the short end high enough, then the return for the riskless rate, investing the riskless rate, is higher than the return of investing in the real economy or investing long term. And so what happens is that when that doesn't have any effect, the shape of where the riskless rate is doesn't have any effect on investment really until you hit the point where the riskless rate is higher than the long-term return. And at that point, what you get is a dramatic switch out of investment into just holding money in short-term securities. And that's the effect that we see in the data this century. And as soon as we get the riskless rate, that shape in the yield curve below about 0.5%, then everybody wants to hold their money in cash. Nobody wants to invest, and so the economy rolls over. Now, the good news about that is, though, that the length of time that takes in this century is about 9 quarters. Around about 2 years. The second good piece of news is that I've said that the barrier here is plus 50 basis points, 0.5%. Right now, the yield curve is a positive 125 basis points. So I can say right now, standing here, that based on the data of this century, the US economy will not go into recession in the next 2 years. But I think what Patrick Harker is noting is that if the Fed continues to tighten, as it will next quarter and the quarter after that, and I believe the quarter after that, then you will eventually, inevitably, reach a position sometime next year where the yield curve will invert. And following that, around about 2 years later, you'll have the next recession. But right now, where we're standing, even though we are aware of this, and we, and the yield curve is flattening, it hasn't reached a point where we will see a US recession anytime in the next 2 years.